Hey folks, welcome back to another Alphabet Challenge update, and this is for week 34. We ended last week right down here at 90.63, which means Alphabet fell through both my 93 and 92 short puts. So I made $136 in premiums, picked up 200 shares at an average price of $92.50, and I'm back at owning 500 shares of the company. My average cost did go down a little bit, so that's always good. It means I don't need Alphabet to go up as much to break even. And the stock closed down $3. So here's what the graph looks like. Basically, I've just been in this chopping motion going up and down. So maybe this week is going to be up again. But overall, so far, my rate of return annualized is 29%, even though I was down 1,600 last week. But what about for this week? Looking at the MACD, we are below the zero line and it looks like it's pretty flat. So this does give me a negative bias. Last week, I was thinking it was going to head higher, but obviously that did not happen. I mentioned since the MACD crossed over the signal line, we're probably going to see some green bars here on the MACD. And in recent history, that's always led to higher stock prices when we had these higher green bars above the zero line. But for whatever reason, we only had 3 green bars before going back to small red bars again. So that's why the stock fell back in this main red bear channel that's been going on for over a year. So now we're kind of like at the tipping point, I guess. I mean, the stock right now, today at 91.66, is pretty much on that line. So I am bearish, but at the same time, I drew this yellow line in here, which connects the low swings from the previous time and the time before that. So I think there's a good chance that this week the stock is going to finish between 95, which is the previous resistance, and around 88. So somewhere between here is most likely where the stock is going to end. So I'll probably have some puts down here, maybe just sell one put at 88. And then I'm actually going to move this up because the wicks do go a little bit higher, so maybe like 96, something like this. Let's take a look at the option chain. And the change of the blue shades from darker blue to lighter blue represents different standard deviations. So at 88 and 87.5, between here is one standard deviation. And then up here we have 96 is one standard deviation. So that just means there's a 68% chance that Alphabet is going to close the week somewhere between those two levels, 96 and 88, assuming a normal distribution. So that's pretty much where I have my markers at, 96 and 88, which is pretty much one standard deviation on either side. So I think what I'll do this week is sell a put at 88, and then I'm going to sell a bunch of calls around maybe 95 or 94. If you remember from like a couple weeks ago, I do have a Google 96 call expiring this week on Friday. And so far that's been going well. I sold it for 64 and now it's only worth 33, which means so far there is an unrealized profit of $31. I'm going to leave that one there and not do anything about it because it's probably going to expire out of the money if Alphabet closes somewhere between 96 and 88. But I am going to write maybe like 4 more covered calls below 96 or around 96. Okay, so in the option chain here, let's do the put first. I'm just going to sell a put at 88. Actually, maybe 87 just in case, because this yellow line is slightly above 88, so it could just fill at like 88.1. So if I move this to maybe 87, there'll be a higher chance that it will expire out of the money. And I should be able to get around $34, 35, let's say. Okay, now let's do the calls. The calls are going to be fun because you can see at 96, which is the high point of where Alphabet can go to, I can already make 36 cents. My average cost, thanks to what happened last week, is now at 94. So as long as Alphabet closes at 94, then I break even on all the shares that I have right now.
Order filled.
Oh, it looks like the 87 put got filled at 35. Okay, so now let's do the calls. Maybe I will sell, I'm planning to sell 4 calls because I have 500 shares. 100 shares is already accounted for at the 96 strike expiring this week. So maybe I'll sell a call at 93, 94, 95, and another one at 97. So this is 4 covered calls plus the 96 that I already have that I put on a couple weeks ago. And that would be a total of 5 covered calls for this week. And for just the calls, I can make about, it looks like 290 or something. So that's going to be quite a lot of premiums. Also, IV is pretty high this week.
Order filled.
Okay, there we go at 296. All right, so I sold an 87 put at 35. And then I sold a bunch of calls, 296. And then minus commission for this week. Convert this to Canadian dollars. That's $449. And that's a pretty large credit this week, partly because the implied volatility is higher, and partly because I'm willing to go closer to at the money. Like these deltas here are like 40s and 30s for 93 and 94. And the reason is because I'm sort of bearish on the stock, so if the stock is gonna go down, then I want to put my short calls closer to at the money. The other reason I'm okay doing that is because I was able to lower my average cost. Like if I was holding the stock with an average price of say like $99 back like several weeks ago, then I probably wouldn't be selling like 93 and 94 calls, because if Alphabet just blasts through that and goes like all the way to 96, 97, then that's just going to be a lot of realized losses. So let's see how the week goes. Thanks a lot for watching. Good luck with your investments, and I'll talk to you next time.